Hey, David, how's it going?
Hey, good, thanks. How you doing, man?
Good, man. Spring is officially here, and I am loving it over here in Cleveland, Ohio. It's finally nice out and actually getting to spend a lot of time outside. It's been awesome.
Yeah, it is fantastic to see the sun shining again, the snow melting. It's a new season.
Yeah, unfortunately, all the projects that I'm neglecting inside, now that I'm just playing outside, are like, that's future Nate's problem. I can deal with that later.
Oh yeah, next winter, right? That's for
Exactly.
next winter in the Midwest. We have to enjoy this like 4 weeks of summer that we get, right?
That's where it feels the best for sure.
Yeah.
So, in the spirit of new projects, right? That's what kind of what we're talking about this episode
hmm
is projects and creative financing, paying for these projects in a way that we've actually never covered before.
Yeah, and I think it's good to open up some of this creativity because the market seems right now like it just demands creativity. It's not the days where deals are all over the MLS and you can buy anything and it's a cash flowing rental. Like right now, you have to be really specific and you have to be creative to make something work.
Yeah, I mean, we're seeing house prices is pretty flat right now. I mean, nothing's really dropping the way we would hope, right? To kind of make more
hmm
deals available. Interest rates are pretty steady right now, 6.5, maybe even up to 7% in some cases, depending on the type of loan that you're getting. So, like you said, not a lot of true deals to be had, but doesn't mean there's not things worth buying. It's just like you said, you have to be a little more diligent, a little more creative, which is sort of the theme we've been dealing with for a while now.
Yeah, and I don't want to take away that that isn't happening. Like just as an example, the most recent duplex that we bought here in Michigan was a seller finance option where the seller wanted a little bit higher price, but they were willing to be the lender on the project
Mm.
and they were willing to lend at a pretty aggressive interest rate. And that created a really nice win-win where they got their price, they got to retire from being a landlord and get a monthly check. We got a property that had cash flow potential and we could go in and fix up the seller slash lender didn't want to fix it up. So it created a really nice win-win. And those things are definitely out there. But again, that's a little off the beaten path with a
Mm.
creative finance strategy.
Yeah, and we've talked about some forms of creative financing in the past. In fact, we colored seller financing back on episode 34. And so again, there are great options out there, but we thought we would throw another one out there because again, like we said, this market sort of demands that creativity. And this is something we've never covered on the podcast before, and that is PACE financing. So we're going to be talking about energy efficient financing, some ways that you can get creative with that. And to discuss that, we brought on the expert, well, the expert in my book, my
Yeah.
old friend, Colin Kalvas, an attorney that deals primarily in the PACE financing world. Colin and I go way back. We've known each other since like ninth grade. And when I learned that he was in the PACE financing space, I said, like, come on, answer all our questions because this is a really interesting space that really not a lot of people are talking about.
Yeah. And just as a quick spoiler alert to give some context, PACE financing leverages some creativity to allow borrowers to leverage equity in their property to make environmentally friendly improvements. So things
Mhm.
like new windows or a new roof or new HVAC system. There's ways that all of that can play together, especially with solar panels and things like that, insulation, lots of things that investors are paying for anyway, but you may be able to fund through a PACE loan.
Yeah, and the unique thing about this is that you are getting that construction loan for those energy efficient improvements and then paying it back in a pretty unique way to spread that payment out over a long time. So if you're going to be doing those improvements anyway, you get the benefit of that improvement right up front, and then you spread out the costs over that long period to be able to finance it in a way that again we haven't discussed before.
Yeah, and there's definitely a few catches on here. So there's things like geographic restrictions or property types, and it's not going to be every renovation that you might be looking for in that property because not everything would be deemed an energy efficient renovation. At the time of this recording, there's some states that allow for this in residential space. So even
Mhm.
on 1 to 4 unit buildings, if you're a single family rental investor or short term rental investor, like those things may be viable there as well. There's also a lot of commercial opportunities, so larger multifamily buildings or just general commercial real estate. There's a lot out there where this may end up being a fit.
Yeah, that's where you and I first ran into it, right? Was in the large multifamily space. We're working on a pretty big project right now, larger multifamily renovation project, and we've been evaluating PACE as one of the options to consider. And again, if you had asked me a year and a half ago what this was, I had never heard of it. So
Yeah.
really nice to be able to dive deep in with someone like Colin, who's an expert, and get all of our questions answered about what this actually looks like.
Yeah, and for those that are listening that are doing a very straightforward renovation project, like a new kitchen in a single family rental, like, this may not be a fit for everything, but rather than thinking through like, well, I'm not doing an energy efficient thing today, the way that we're approaching this episode, and as you hear, we do some pretty rapid fire Q&A throughout the episode, which I think could be valuable for investigating a bunch of different lending strategies. So whether that's DSCR loans or seller financing, portfolio loans, commercial loans, private lending, there's a lot of creative finance options out there where you might consider similar questions. So getting your mind in the gear of how would I evaluate a financing strategy may be very helpful, particularly as we're in an era where typical conventional mortgages may not be the product for everybody to fuel their investment.
Yeah, and keep in mind too, right? The two reasons that I would say really to pay attention is that one is that you never know what project you're going to get into next. If you had
Yeah.
asked me 3 years ago if I'd be in the large multifamily space, I'd say no, residential's my thing. Like that's it. I wouldn't need any type of loan like this ever. No renovation project like that. And now all of a sudden I'm knee deep in it, right? So you don't know what's coming. And two is that again, this can apply to a residential space, right? You could be putting solar panels on your roof next year, and this is one of the loan options that's out there. So it's something that I think applies to really everybody involved, whether you're in the large construction space or not. This might be applicable, and it just gives you those extra tools in your toolbox that you might need down the road.
Yeah. So I know we often focus on that investor's journey and
Mm.
story in an episode, but again, I really hope this Ask the Expert kind of episode structure works really well as you're evaluating, could PACE work for me? Could other loan products work for me as we look into a really odd 2025 that's just going to be driven by a ton of creativity.
Yeah, for sure. Well, hope you guys enjoyed the Q&A with Colin, and with that, we'll take you to the episode. Hey, Colin, welcome to the show.
Hey, thanks so much for inviting me on.
Absolutely, man. We this is a cool moment for me. I don't often get to interview old time friends. We go way back to ninth grade, so this is cool to have you on the show. I said before we hit record, like it's weird that our goofy friends grew up into like actual adults who know stuff. So really happy to have you on the show talking about real stuff. This is cool.
It's funny how that tends to happen, right? Yeah, we all grow up.
Sometimes I feel like I'm waiting for the adults to show up in the room, and we're them. So I guess this is it.
There we go. There we go.
So why don't we jump right in? Give everybody a little bit of just background on yourself and some of your training, and we can dive in from there.
Sure. Well, my name's Colin Kalvas, and I am a lawyer. And I guess because I went to law school, and the punishment that I have for that, I should say as we get into this, I am a lawyer, but I'm not anybody who's listening to this as lawyer. And so none of what I say is legal advice. And if you need some legal advice, I would suggest that you find or talk to, the lawyer that you trust. Coming out of law school, I was fortunate enough to find a job with a law firm that has what we call a public finance practice. And that, mainly deals with public entities and how they either pay for their own assets or can help in public-private partnerships with private parties to make development work. So in that context, I got involved with a number of different kinds of public-private partnership tools that are used for development. And one of them is property assessed clean energy, or PACE financing, which is what we're going to talk about today.
Yeah. So let's jump into that then. The property assessed clean energy, which I hear more often as PACE financing. Can you walk us through what that is? Big picture, zooming out, what does that mean? And what kind of things might that apply to for a real estate investor?
Yeah, absolutely. The biggest thing to keep in mind with PACE is ultimately it is a source of financing. So when you compare sources of financing, you might think about, traditional mortgage lending. You might think about partnership equity. You might think about equipment leasing or equipment financing. PACE is another type of financing. And you kind of always have to keep that in mind, because when we start to get into the details, there's a number of different players involved. It can get a little bit complicated. But at the end of the day, this is a way for a property owner to access funds to do upgrades to their property. And it's a little bit different than some of those other sources, but ultimately it's a financing source. So PACE is a financing source that uses a public mechanism to pay for typically private improvements. And what happened back going on about 15 years ago now, our local governments around the country sort of perceived that there was a need to invest in upgrading our building stock. We had a lot of aging buildings that really could use energy efficiency upgrades. There was also a lot of momentum behind trying to incentivize folks to look at alternative energy improvements like rooftop solar or micro wind or geothermal. And what a lot of policymakers perceived was there's an opportunity for us to use what has traditionally been a public financing mechanism to incentivize this public policy that we want to achieve, increasing the energy efficiency of buildings, incentivizing alternative energy. So what a number of different state legislatures did was authorize local governments to put what are called special assessments on property as a way to both secure and repay upfront financing that the property owner can get to pay for those eligible kinds of improvements. So you can see where it starts to then get a little bit complicated because you've got a government involved, you've got a property owner involved, you've got a lender involved. But again, it's really just a financing source, and it's using special assessments rather than some of the other kinds of things that other sources of financing might use.
Yeah. And then what would be some other examples of the clean energy updates that might play in for, especially some of the smaller residential units? Or is that not really the typical focus? Is this typically more of a larger commercial building kind of thing?
Yeah, it's a really good question. And actually, over the history of PACE, the answer has probably been a little bit different at different times.
Okay.
So PACE really started out as a residential effort in California and Florida as kind of the tip of the spear. There was a lot of investment in residential PACE, and what homeowners in those places were experiencing and using PACE for were kind of standard things like HVAC upgrades. You have an air conditioner that goes out, you want to upgrade it, you think, I might as well go for the more energy efficient model. This is a way to help me pay for it. There was a lot of investment done in that kind of mode, but also the rooftop solar, as you can imagine, in places like California and Florida. Very good environment for rooftop solar, incentives available to try to help bring down the cost of those things. And then PACE was a source of financing that could help pay the costs that you are, obligated to pay. So for a while, it was really heavy in the residential space. I think once things sort of started to develop in that area, folks perceived, well, we could really use this for commercial as well. And the capital markets sort of started to see PACE as something that they could understand and underwrite, and that they could put bigger dollar amounts behind. And because of that, commercial PACE has kind of taken off. And because of the project sizes and scopes, it's now a larger segment of the market than the residential side. There's also been some bumps in the road on the residential side, unfortunately, and that's caused some contractions and a little bit of a stagnation in terms of the expansion of residential PACE. But it's still something that is done and available in Florida and to a lesser degree in California still.
And so when you're getting this financing, I guess my understanding of it was that it's not a typical loan, right? It's still money being paid up front, but in terms of the payback, it's not a typical loan payback. This is actually being attached to your property taxes. Is that typical for all these projects you're talking about, or is that the norm?
Yeah, and one of the things about PACE that's always has to be kept in mind is that because it's a public financing mechanism and it's using this special assessment mechanism, it's going to be state law specific. So, I was mentioning like residential PACE in California and Florida, that in those states, those things were authorized, and the special assessment mechanism sort of followed the way that their property tax system works in those states. Mm-hmm. It's a little bit different in every state how that actually works. But the key sort of fundamental thing with PACE is that it is going to be a property tax item, and that has some advantages, and it kind of makes PACE work the way that it does.
And so how did you first get injected into this? Is it like something that you yourself are not a real estate developer going out and getting these loans, right? You're assisting these public entities with doing so. Is that right? Or how are you involved in the day-to-day with this?
Yeah, it's a great question. Again, kind of coming from the public-private partnership background, we had a number of local government clients that were interested in this and kind of came to it from that lens, but over time have worked in a number of different capacities, yes, on the local government side, but also a little bit on the property owner side and also on the PACE. We call them capital providers is kind of the terminology on the PACE capital provider side. That's the folks that are giving the upfront funding.
So let's unpack some of the pros and cons of where this might be a good fit, different types of projects or different ways that an investor could really leverage this as an opportunity to enhance their investing. So let's start off with, are there project types that really stand out to you as, if you're doing this in this type of building, think about PACE financing?
Yeah, that's a great question. I think I can speak a little bit from what we've actually seen happen as maybe a way to address that. So I would say that on the commercial side, and when we say commercial, we should probably be clear. In most states, a commercial asset is going to be something that has 4 or more residential units if it's used for residential purposes, or then obviously anything that has purely commercial purposes like an office building or retail or things like that. But on the commercial side of the equation, I would say that multifamily certainly has been an area of a lot of PACE investment. Hospitality as well, whether kind of traditional hotels or even sort of more boutique bed and breakfasts, things like that. Senior living has seen a lot of PACE investing over the years. And to a little bit of a lesser degree, office, and that's a little bit tracking the overall market trend for office space. Where we see PACE a little bit tougher on the commercial side is on really specialty assets. So if you think about a big data center somewhere that's built specifically for a specific user, or if you think about indoor agriculture, other types of really specialty assets, those can be hard, mainly because of the credit underwriting that the PACE capital provider is going to do. It's not a super fungible asset, and therefore they're going to have a hard time finding a new buyer in the event that there's ever a need to sell the property in a foreclosure situation, and it just makes the underwriting tougher. So it's certainly on the multifamily side and hospitality and senior living, PACE is kind of an easy proposition. The farther you get away from that and into more specialty types of assets, the tougher it can get.
And I guess it begs the question, is there like a minimum or a maximum? I mean, we've been talking about everything from, big commercial, like a hotel, down to like putting solar panels on my roof. Is there a minimum or a maximum for these types of loans, or is it all across the board?
Yeah, I would say there's certainly no maximum. And that's been an interesting development. Even over the past year or so, we've seen hundreds of millions of dollar amounts in PACE financing. So the large side of the market is growing, and there doesn't seem to really be a ceiling to that. On the small side, there's probably sort of 2 lenses to think about that question from. One is from kind of a underwriting perspective, and another one is from sort of a cost effectiveness perspective. So on the underwriting side, most PACE capital providers are only going to be able to provide PACE at up to maybe around 35% at the most of a property's value. And so when you're talking about, sort of small dollar value assets, the PACE amount that could go in there, might not actually be that significant. It might not be enough to pay for all the things that a property owner would like to do, depending on the value. On a cost effectiveness side, traditionally PACE has been a little bit higher on the fee load because it is kind of complicated. You've got the government involved. You've got a number of different sort of background diligence things that need to happen. We can talk a little bit about that. That's a little bit different than traditional lending. So the cost to actually transact in PACE has been a little bit higher. One of the really exciting things that we've seen in the last probably year to 18 months are a number of small local community banks and CDFIs getting really involved in PACE from the actual lending side. So there are traditional banks that are now using this as a source of financing with their customers. And banks are really, really good at deploying capital and doing it at a cost-effective way. So their costs associated with some of the smaller balance PACE have been significantly lower than the costs that we're used to seeing kind of in the traditional PACE market. So I think we would expect to see that continue and to kind of bring that minimum dollar amount from a cost effectiveness standpoint kind of continue to go down.
Okay. So less of a fit if it's like your furnace went out in your house and you're trying to fund a few $1,000 thing. More of a fit if it's like an Airbnb beach house where you're looking to do new solar panels, new HVAC with air conditioning, with windows, with that kind of thing. Am I understanding that right?
That's probably right, David. Yes. And the other thing about residential versus commercial, we kind of talked a little bit about the fact that the market developed were residential starting in California and Florida. There have been a number of sort of regulatory things that have come up over time in the residential space. Unfortunately, there were some issues that arose with contractors and kind of the way they were interacting with some of the property owners. And also there was I think, a rightful perception that this really is a financing tool. And for a while, it was not regulated the way that other forms of consumer financing were regulated. So there's been a push to kind of bring it more in line with the ways that other consumer loans are regulated. And there's been sort of some fits and starts with that. But in general, through that effort, on the residential side, we've kind of seen a slowing of the increase in the use of PACE for just kind of that HVAC replacement that you're talking about.
Yeah.
I've heard those horror stories of like, and maybe this isn't PACE, you can correct me if I'm totally wrong, but like where the door-to-door like solar salesman is like, you don't pay anything. We just throw it on your roof and like, don't worry about it. And then 2 years later, it shows up in their property taxes and they have no idea where it came from. They've never been underwritten on that loan. They might have fixed income and they have no ability to pay that back anymore. Like, that's the bad stuff, right?
Yeah. Unfortunately, we've heard those stories too. And the good news on those is that I think the market has appropriately reacted and put a lot of safeguards in place.
That's
So
good.
where residential PACE is available, there will be things now like, a confirmation of terms call where you have to speak with a live representative to confirm you understand that there's going to be a special assessment on your property. You understand that you have to pay this back, those kinds of things. There is significantly more underwriting of not only the property, but also the actual property owner that now takes place. There's kind of truth in lending things that are involved. So the market has definitely reacted to those horror stories and tried to address them. But yes, they were out there, and I think that caused some hesitancy in the expansion on the residential side.
That's good to know.
Okay. What about, I know a lot of investors jump into a property and they kind of cash flow repairs over time, meaning they're doing a few things here, then they're going to wait and they're going to do a few more things and they're going to do a few more things. What about that person that has already kind of started on some renovations and is now hearing about PACE financing? Can this be used retroactively for reimbursing recent things and putting a larger umbrella over a portfolio of renovations? Or is this only forward looking?
It's a really salient question currently, because a lot of folks, are finding out about PACE now, and they're thinking, whoa, I just did a bunch of stuff that I think could qualify for PACE, last year. Can I use this tool? And in a lot of places, the answer is yes, but it's a little bit state and program specific.
Okay.
So there'll be different guidelines for kind of how far back you can go, what you may have had to do at the time that you were doing the improvements in order to kind of qualify them for later reimbursement, and then how the money kind of comes into the property or to the overall sort of capital stack that exists with the property. But in general, the answer is yes, for some period of time, you can look back and kind of capture some costs of some projects that you may have already completed.
What about contractors? Do contractors need to be like credentialed in a certain way, or is it just kind of basics like licensed, bonded, insured, or is it could an investor even do some of their own work on their own project and have materials paid for with PACE?
Yeah, and that's another one that has sort of evolved over time. A lot of the models for the early PACE development had contractors that would get kind of signed up on a platform to be able to go out and sell not only the improvements that they were doing, but also PACE as one of the financing options for it. I think the market has generally moved away from that model to where, any contractor that's involved with a project, as long as they're, licensed, bonded, insured, like you said, is going to be able to perform the work. In PACE, we mentioned this earlier, there's a little bit of extra diligence that's needed in ensuring that the improvements that are being financed qualify under the relevant rules. So, in general, PACE can be used for those alternative energy and those energy efficiency improvements. But what that means in every state is a little bit different. And how you prove that something really is energy efficient is a little bit different in every state. And typically, there's going to be a professional that gets involved to actually show that by doing calculations, energy savings calculations that fit under those rules.
Is that typically a consultant, or do you have a contractor that gets to that level of knowledge that they're doing that for the customer?
Yeah, it can be different things. There are folks out there that specialize in that kind of thing.
Yeah, I can see that.
And they'll come into a project and they'll do the analysis for you and they'll kind of provide whatever it is that you need. But a lot of times, the architect or the engineer or the contractor that's involved on the project actually has somebody in their shop that can do those calculations as well. There are a number of free resources that are out there that can help with that too. The Department of Energy has some calculators that a qualified engineer can get on and input a bunch of data about a building, and then it kind of spits out what the energy savings are. So there's probably a lot of different ways that you can slice that, just depending on, who's already involved in a project and what the local need may be.
And I guess I didn't ask this earlier, but it's kind of churning in my head now. Like, so I get the loan, I fund my project, do the rehab, then they start assessing it in whatever state way my property taxes follow. How long is that typically like metered out over? And then what does that look like when I go to sell the house or want to pay off the loan early? Like, can I pay off my property taxes early to get like, how does that all work?
Yeah, those are really good questions and ones that a lot of times, a property owner really needs to think through before they pull the trigger on using PACE. The term of PACE financing is typically tied to the useful life of the assets that you're financing.
Makes sense.
Okay.
And in a lot of ways that's good for everybody because it kind of helps match up the loan payments with the savings that you're hopefully achieving from, the energy efficiency improvements. But it also ensures that you're not, borrowing something that's sticking with the property way past the time that you're even getting the benefit of the improvement. So a lot of terms will be, 15, 20, 25 years, something like that. Again, kind of depending on the life of the improvements that you're financing. An industry standard in PACE has been that it can be prepaid. So you can pay it off early. And typically that is at, the outstanding principal amount plus any accrued interest. And then depending on where in the term, there might be a little bit of a prepayment penalty. But that's typically something like starting at maybe 5% and kind of graduating down over the first 5 or 10 years. Until then, there's no premium if you're beyond that period. You don't have to prepay all of the future special assessment payments because fundamentally what the special assessments are the full amortization of the loan. It's the principal repayment plus the interest plus any administrative fees or servicing fees that need to be collected. So typically you don't have to prepay all of those future assessments to get out of a PACE loan. You're just paying principal plus accrued interest plus any premium that might be due.
But it's still a first position mortgage though, right? So, or a first position on the property, right? So if I go to sell it, like, do I have to get rid of that first?
Yeah. And by first position, we should actually be a little bit specific about what is in first position.
Why I brought the lawyer on the episode, not me.
Yep.
Yeah. Such a lawyer answer, right? No. One of the big advantages of PACE is that it cannot be accelerated. So just like property taxes are only due for the year in which the bills are out there, and they're actually outstanding, you cannot force a property owner to pay future special assessment payments in any given period. What that really means is that for the lien priority, only any unpaid special assessments have priority over private liens. You can't accelerate the full principal amount of the PACE loan to become, prior to a mortgage or some other type of lending. It's only the unpaid amount. And that's a big advantage for PACE because that makes it so that senior mortgage lenders are willing to agree that PACE can go on to property, and it doesn't interfere too much with their mortgage. So then one of the other advantages with the non-acceleration is that typically there's a corresponding ability to transfer the property to another owner, and you don't necessarily have to pay off the PACE loan. That's a negotiation that has to happen between the seller and the buyer. How do you want to handle this PACE that's sitting on there? And, I would say sometimes the buyer says, to the seller, hey, we want you to pay it off, just like the mortgage that's sitting on there. You need to pay that off for me to be able to buy this property. But oftentimes we've actually seen that a buyer says, no, I get it. I see the improvements that you did. I see the energy performance that's associated with that. I'm okay with stepping in and assuming these assessments going forward. So that is a possibility and another one of the advantages of PACE.
And so in a refinance situation in a purchase situation where someone's coming in with financing on that, like Fannie, Freddie, like some of the major lenders, they don't really have a problem doing that. It's easy to move that forward.
I wouldn't necessarily say with some of the federal programs that it's easy. I think folks have found ways to kind of make that work in different contexts. I would say, the easier path is certainly when you're not necessarily looking to some of those federal guarantee programs or underwriting programs as part of it. One interesting thing kind of on the commercial side is PACE actually is compatible with SBA lending. And there are a couple of hoops to jump through with that. But in general, it's compatible. And, I've worked on a number of projects where there's SBA lending and PACE.
That'd be cool. Yeah. Start up your own green business and get it paid for. And
Yeah.
Yeah.
I'm imagining too, some of the loan terms on PACE funding would be, better interest rates perhaps, or things like that to justify some of the fees. And so also then if someone's purchasing or refinancing, it could be advantageous to keep that debt there in a lower interest rate than what we're seeing in the open market right now.
Yeah, that's definitely one of the advantages of PACE. So that high lien priority that basically guarantees that the PACE lender is going to get paid current. They're not necessarily going to get paid out of the deal, but they're going to get paid current. That lien priority typically enables them to offer interest rates that are incredibly competitive versus other forms of junior debt. So PACE is almost always cheaper than subordinate lending, mezzanine financing, partnership equity. It's usually a little bit more expensive than mortgage lending, kind of senior lending, but not always. And, recently with where interest rates have been, some of those rate spreads have actually been very, very close, PACE versus traditional lending. So you're absolutely right, David, that somebody might take a look at a property and say, I'd actually like to keep this PACE on here because I can only max out my senior lending at 65% of the appraised value. I've got to figure out what I'm doing about the other 35. And it's actually pretty cost effective in terms of cost of capital for me to keep some of this PACE on here and pay it at a, 8% interest rate instead of my other options.
all right, so Colin, you got my head spinning. We're going through a small addition at our house right now, and I'm kind of wondering, like, man, should I have gotten PACE financing on this? It's not an energy efficient upgrade, so it's probably not a good fit. But still, I'm thinking about it. If someone is like, look, I have this project, I think it's perfect. I heard this today. This is the most I know about PACE. Like, what are some of like first steps to kind of get rolling on just figuring out if PACE financing is a good fit? Like, do I get a contractor first? Do I get a lender first? Do I call a lawyer first? Like, where do I go to get off the ground?
I'd love to say you should call a lawyer first, but you
Nobody
shouldn't.
does that. We call a lawyer last. Once there's a problem, then we're like, oh my God,
Right.
save me. Yeah.
Right. No, and really it's not the right answer. The right answer is probably that you want to check if you're somewhere where PACE is available, because PACE is pretty widely available, but it's not available everywhere. So
Okay.
currently there are about 37 states plus the District of Columbia that have it. But, that means that there's a handful of states out there that still don't have it. And even in those states that do have it, it's not necessarily available everywhere in those states. So there are a couple good resources to kind of get you started with that. There's a group, an industry sort of trade organization called PACE Nation. And they've got a website and they've got a map of where PACE is currently enabled. And it'll have a little bit of information about kind of what the program is called in that state. And then, if you want to do some follow-up research, probably look into what that program is and where all it's available within the state. It's kind of a first step. So first, just sort of checking, could I even do it if I wanted to? Once you know that, probably actually getting in touch with that program is maybe the best way to go, because they're going to help talk you through exactly what is required for them, in terms of the energy savings calculations. They'll also probably have a list of lenders that you could talk to about, who should I try and get some terms from, or who can I talk to in terms of actually getting the PACE financing. And they might also be able to guide you through any contracting requirements. So honestly, that's probably, if you're starting from, the starting line, that's probably the best path to go, is actually to kind of engage with the programs, because they're going to be able to guide you through what to do.
That's good advice. And then the other thing that I'm thinking about is, you mentioned earlier that it can take a little bit of time to coordinate all this, right? You've got the government involved, a lender, a contractor, like multiple entities. So it's probably not a super fast process. What are you looking at for like typical, and again, I'm sure it varies based on project, but like typical timeline, is it twice as long as mortgage lending, 3 times? Like, I mean, where are we at?
That's a really good question. I think a lot of the process, honestly, at this point is similar to other types of financing.
Okay.
So a lot of what's going to drive the process is going to be just underwriting diligence. Things that would speed it up would be, if you've kind of got your ducks in a row already with financial statements that a lender is going to be looking for, or, entity documents that they're going to be looking for. A lot of the diligence that goes into it is going to drive the process. I think a typical timeline from kind of getting to a signed term sheet, or, a commitment or term statement from a lender to getting to closing is probably in the 45 to 60 day range.
Okay.
So it's probably a little bit longer than traditional mortgage financing, but not a lot.
That's good.
Yeah. And any other rules of thumb as you're looking at this for if it's, involving X number of types of upgrades or X number of dollars, like make sure it's at least this much for it to be worth the effort? Or is it really just super project specific?
I would say that, PACE is going to be most effective in a situation where you can replace a significant amount of either cash or, again, like partnership equity or junior debt that you would be thinking about putting into a project. That's when it's going to be the most effective. Where it's not that effective is when you still have traditional mortgage lending capacity that you can access to pay for these improvements, or just, with whatever you've got going on with the project, or you've got a cash requirement, an equity requirement that you're not going to be able to get any lower, and you're just going to have to put it in, and the project scope is within that. It's when you kind of have a gap where, you've got the amount of equity in that you need, you've got your senior lending, but you're still trying to figure out how to pay for these other items. That's where PACE is probably going to be the most effective. And I don't know that there's necessarily a dollar amount on that, but that's kind of the situation.
That makes sense.
Okay. So we're recording this in early 2025 when there's been a recent administration change. So I don't want to put value statements on any of that or take a political stance in any of this, but there's definitely a shift in a lot of policies in this realm. So do you see the shift on environmental aspects, global warming, some of those kind of things impacting PACE financing in this approach? Is this something that's going to go away, or it's at risk, or states will start dropping this? Or is this something that you see as safe and will be here for a while?
It's a really good and important question, obviously timely for when we're recording here. A couple of the things that I think make PACE a little bit more resilient to some of the headwinds that, the Green New Deal or green financing are facing currently are the fact that it doesn't involve any kind of a cash outlay from the government. So, we're talking about private money coming from a PACE capital provider going into a private project being repaid by a private property owner. There's no governmental money anywhere in that equation. Yes, there is a governmental mechanism, the special assessment mechanism, but it doesn't cost anything to the local government. There's no subsidy involved necessarily. So I think that makes PACE a little bit resilient to some of those headwinds. The other thing about PACE that we've found over time is that, yes, it was originally conceived of as advancing energy efficiency and alternative energy policy goals. But where it's actually been really effective is in promoting just investment in buildings, kind of the economic activity of that, and job creation. So there's been a lot of, contracting work that's come out of the fact that PACE is available. There are, those energy engineers that are involved in these projects. And just the fact of being able to do projects that may either bring new workers into an area or, actually have jobs associated with the project has made PACE kind of a economic development, job creation proposition for a lot of places. So I'm hopeful that PACE can withstand some of those trends that we're seeing right now. And I think because of the fact that it's not involving government money and it furthers these goals of just investment and job creation, that we may see that be the case.
I think that's really good perspective, and it gives a good idea of why that's the case. So I appreciate that. Colin, this has been awesome information, and again, a topic that we have never covered on the show before. So really, really happy to have you on to kind of divulge your expertise here. If people want to reach out just to connect, learn more, or reach out to your firm, where can they find you?
Sure. No, and thanks again for the interest in this topic. It's it's kind of a little bit of a niche. Not everybody knows about it, but I do think it's becoming more widely talked about. So appreciate the chance to come on and hopefully share some information about it. Yeah, I'm not super findable. I only have a LinkedIn, so you can try to find me on LinkedIn. But I'm not super responsive there. But otherwise, just by email. I don't know if you guys have that and can give it out, or
We can drop it in the show
I'm
notes.
happy
That's
to just
easy.
give it. Perfect. There we go.
Yep.
Cool. Well, Colin, again, thank you so much for sharing all this. Really appreciate you coming on, and again, just really fun to get to interview a long-time friend. So thanks.
Thank you guys. It's been great.
Thanks so much.